Hi, this is Jeng, and today we're going to be talking about how to analyze a multifamily deal. And we're going to take sort of your base case scenario, but then that's just the first step, right? So you run your base case scenario, and you really have to get into all the different scenarios that are out there, right? So you have to interpret the results and figure out, all right, if I change this, what impacts to the returns do we have? So, in the last video, we talked about, uh, 200 unit deal, sort of 1980s, just like a sample deal here. One bed, 70%, 30% two beds, in place rents of about $1,000. Going to take the rents up about $75, 95% occupied, just your standard deal. And we came up with, after sort of plugging it into the model, we came up with a price of about $21.5 million that we would pay for this to get to our annual return. So flipping back to the model, we really had four boxes, right? So we had the inputs here, the rent roll, the expenses, and then your projections in box 4, and then box 5 through 10 were really all the outputs for the deal. And so what I wanted to do in this video is really to go through some different scenarios on how to look at the deal and see what are the main drivers and how to make sure you firm up those assumptions, right? Because those are the things that are going to be driving the overall return. So when you look at this base case, you're at initial investment of 6.2 million, total return of about 70%, cash on cash is about 6%, IRR 12, sponsor is going to make about $1.2 million. And so how did we come up with those numbers? Let's talk about these a little bit in more detail because this is what we're going to be using in our analysis. All right, so initial investment. So this is, if you look over here on this side, I like this chart. This is the sources and uses. And I think this is really important to understand because the lender is going to ask for it. The equity investors are going to ask for it. So you build out, you have your purchase price, plus your rehab, plus closing costs, plus working capital. And we're going to talk about these two additional fields here, reserves at close, which Fannie and Freddie are making you have right now, and then also acquisition fee potentially. And that's your total uses, right? So that's how much money you need for this deal. And who's going to give you money for it, right? So you have the loan amount, which is 16.7. We assumed about 75%. And then equity. So that initial investment of 6.2 million, that's your initial investment. And that's what all your returns are going to be based on. All right. So that's number one, initial investment, 5-year total return. So this is going to be your total passive cash received minus the initial investment, right? So I got to give you the initial money that you gave me back and divide that by the initial investment. So let's go back to the model. So I want to show you this, where this is coming in. So the number, so we go here, 5-year total return. And you can see that it's taking your total cash minus your initial investment, so 4.3 million in this particular example, divided by that 6.2, and that's your total return. So that's the cash over and above your initial investment that you receive over the 5 years. All right, and then IRR, so this is going to be calculated here. So you put that initial investment of 6.2, and this is going to be your cash flow each year. All right, and this is your sales proceeds at the end in year 5. So you take that stream of income and calculate the IRR right here. So that's the second one, that return metric that we're going to be looking at. Average cash on cash is just going to be your passive cash on cash here, average over the 5 years. And then your total sponsor comp. So this is going to be your asset management fee, which you're going to receive annually based on percentage of income, your cash flow to the sponsor based on your equity override, sales proceeds here in year 5, and then acquisition fee in year 1, which we're going to add in this model. And so let's jump in. So we're going to go through some scenarios. And, the thing that people were asking me a lot about is, how do interest reserves impact my returns? So let's go back here. So I added a slide here for reserves at close, right? And so the way I calculated that was essentially, so let's back that up. So this is on a Fannie Mae loan. So if you do, it's essentially 4 things, right? So it's your P&I payment. So you have your P&I payment here, 12 months of P&I. You have 12 months of taxes. You have 12 months of insurance, and you have 12 months of replacement reserves. So you add up all those 4 things, and you get about 1.45 million in reserves on Fannie Mae. And you can do the various scenarios for Freddie Mac SBL, Freddie Mac conventional. This deal is, $20 million deal. So I did Fannie and Freddie conventional. So you can see that once you plug in those returns, your initial investment goes up to 7.6 million. That's going to drive down your total return of 56.7. In this example, I put it back. So these reserves are supposed to be put up. Essentially, the minimum that Fannie is going to hold it is 12 months. So I put it back in year 2, assuming you hit a 125 debt service coverage on a standard deal, that it comes back to you in the form of cash. This, I'm assuming, is just going to be returned back to the investors. So you can see that, your initial investment is higher. So it's going from 6.2 to 7.6 because of that 1.4 million in reserves. And that's going to drive your return down to 56.7. On Freddie Conventional, it's only 9 months P&I. So it's a $6.9 million raise and your returns go to 63.1. So the question that comes up is, a lot of people keep saying, look, I don't want to put up these reserves, it's driving my returns down, which I get, right? You're going from 70 to 56.7. But let's go through the analysis. Deals are still getting done right now, right? So we assumed a base case of 21.5, the initial investment of 6.2. So you go on Fannie Mae, you drop your reserves to 50, or you drop in 1.4 million reserves, your returns go down. And so what do you have to do? What discount do you have to get to make the same return, right? Essentially, that's what you want. Your investors want the same return. So on that initial investment of 7.4 million, the only way that you can get it to the same return is actually to drop the price, right? So we're going from 21.5 to 20.65, and you get to the same 70% return. So I sort of backed into that. So we had 1.45 and we were at 56.7. So I said, hey, all right, let's come in and drop this by 850. 20.65 gets you to about 69.8. You do have to raise more money, right? So you are going from 6.2 to 7.4 million in equity raise, but you are getting the same return for your passive. So that's about a 4% discount, and that's what we're seeing in today's market is probably about a 5% discount to sort of pre-COVID pricing, just based on the reserves coming up. And so that was the impact of reserves. Let's go over. So a lot of people ask, look, I'm an experienced sponsor and I take an acquisition fee on these deals. And so I wanted to build that in and sort of give you a place to put that. So I added it here in the inputs in box 1. So you could put 1% acquisition fee. Let's go back and take this back to the original set base case. All right, so now we're back at the original set base case at 69.9% IRR. And now let's say you put in a 1% acquisition fee. So this 1% acquisition fee is going to hit you on your uses, right? So you're going to use that acquisition fee or receive that acquisition fee at close to the sponsor. So your initial investment goes up to that 6.4 million. And then also your initial investment goes up, which is going to come down, bring and hit your returns to about 65%. So on a 1%, you're about 65%. On a 2% acquisition fee, it goes to about 60%. So every 1% on the purchase price is driving the LP return down about 5%. So just to give you an idea of what your acquisition fee is doing to LP returns, obviously you can see that your sponsor comp is going up correspondingly with that acquisition fee. All right, now let's talk about reversion cap. So reversion cap is here. So we had in the base case 6% reversion cap, and that's a lot of people will take the existing cap rate. So let's say cap rates are 5.5% on a Class B property, add 10 basis points a year, and then in 5 years you're up to 6%. Some people look at a average cap rate, and average median cap rate, let's say for DFW. Over the last 10, 20 years is 6.5%. So they might use 6.5%. So whatever number you're comfortable at, you have to convince your investors that you're comfortable with that, but it can range significantly, right? So base case of 6%, if you go to 5.5% on your residual, goes to 100% total return. 6.5 goes to 43, and 7 goes all the way to 21. So you can say it's a big impact. So really research the cap rate and pick a number that you feel comfortable at. Next thing is leverage, right? So a lot of times people will come in and they'll get a term sheet from us and say, look, what loan amount can I get to? right? And so 75 is sort of your base case right now. But let's say you come in and you only want 70% leverage, right? So that's going to drive down your loan amount. It's going to increase your initial investment, and then it's going to decrease your returns. But it is a safer deal, right? You do have less leverage right now, and you potentially could get a lower interest rate. You potentially could get more interest only. So I just took it at the base level, the different loan and cost levels. So 70% is your base case, 65 drops your total return to 54%, but you have a lower risk asset, 61% on 70%, and then at 80% leverage, right, your total return is 82.7 because your initial investment drops down to 5.1 million. And so if you can get there in terms of coverage and you think you're safe, then you can go up to 80% on if you can hit that 125 debt service coverage, which we talk about in other videos. Next thing is interest rate. So we can come in, plug in, go back to our base case, plug in. We use 3.5%, which is where the market is right now. If you drop to 3%, you get about 5% more in total return. If you drop to 4% or increase to 4%, you're at 65%. And then 4.5%, you're at 60%. And so, I get beaten up a lot on interest rates, and people always want the lowest interest rate. But as you can see in this scenario analysis, like it matters. I get that, but it doesn't dramatically increase your return one way or another, right? So you can see a 50 basis point change from 3.5 to 3 only hits you by 5%. The big difference really on the interest rate side is the leverage. So if your interest rate goes from 3.5 to 4 and your leverage gets cut from 75 to 70, that's where it's really going to hit you right here at that 61%, because it's going to hit you not only with the leverage, but it's also going to hit you with the interest rate. So it's really the combination of the leverage and interest rate that hits you that's going to drive down your returns, probably below 60 on the interest rate side. Rent growth. So this is one that it is hard to forecast, right? Because it's a guess, right? And most people are using they're going to grow with inflation, base case of 2%. But you come in, you plug in, let's say 1% here for rent growth, which is going to be your bigger number, and you can mess with other income as well. But rent growth of 1% here, it's going to drive your total return down to about 40%, right? So 40.5% on. So it has a huge impact because it compounds year over year because you're growing off of that initial year before. And so that's why most people, they might have 0% in year one potentially, or 0% in year two right now, just because of the whole COVID. And you're not pushing rents as much and you're focused on occupancy. But really, you got to get it up to that 1-2% over time, or it's just going to crush your returns. Total returns about 40% on the one. But then look on the opposite side, right? You grow at 3%, you're going to hit that 100% total return. So, as an LP, you got to be careful, really look at the rent growth that people are using. And then also where their base case pro forma is, right? So what are they projecting today? And then what are they growing to? Because that can dramatically impact your returns. All right, sponsor comp. So this is in box 1 up here, percentage of equity. Typically range anywhere from 10 to 20% in terms of equity override. And so base case, you're at 70%. But then if you go to 10%, you get to 75, 20%, you get to 64. So a lot of times, I want the sponsor compensated for doing all the work, for doing the deal. And I really want them to be hustling for the deal. And so I want to pay them as much as possible. And you can see here that, if a deal is really tight, they might lower their sponsorship comp, but in reality, it doesn't affect the deal as much as you would think. So, all right, now years of interest only. And so this was a big thing, the past 2 or 3 years, everybody wanted 5 years interest only. And you can see in this chart, if you come in, this is just an input here, years of interest only. When you adjust this, it obviously improves your cash flow because your debt service payment goes, it was 901 if you pay P&I, but it's only 585. So it's giving you that additional cash flow each year. And your cash on cash is 6% on the base case. If you do 5 years, it's 10%, and then 8% in 3 years. So I think it's probably going to be 1 to 3 years for a while here, unless you're going really low leverage. But in that 75 to 80% range, you're going to be 1 to 3 years IO. But you can see your total return doesn't really move, right? So you have 70% total, 67, 66. So total return doesn't really move. It's really focused on your cash on cash impact here. And so here's a summary of all these different scenarios, right? So there's a million different scenarios. I mean, you guys can get this model and you can adjust price, rehab, amortization, closing costs, working capital, but those are even your pro forma rents and your expenses. So all those things can change, right? But I wanted to highlight some of the things that you should be looking at a high level at. I think the 3 or 4 that are really big ones. Interest reserves are big, right? So that's bringing prices down 4 or 5% in a market where it's going up, 2, 3, 4% a year easily. Reversion cap rate is a big one. So really watch your reversion cap rate, watch your leverage. If a general partner is going super high leverage, is that driving the returns, and how much risk are they undertaking for that, especially maybe on the bridge side versus Fannie and Freddie? And then rent growth, right? So how aggressive are they being on rent growth? Some of these other items, they seem important, but they're not really going to drive the returns as much. So my background, I was born and raised in Houston, sort of been in Texas my whole life, and been an underwriter on the loan side for 8 years, been a lender originating loans, and then also an investor in 6,000 units across DFW, Austin, and San Antonio. So if you have any questions about this model, definitely subscribe to the channel, like and share the video, join the email list, and that's how you get the underwriting model. And then if you want to set up some time to talk with me, whether buying, selling, refinancing, multifamily property, send me an email. I'll send you a personal financial statement template to fill out, and we can set up some time to talk. Thanks a lot, guys.